On the previous video, I showed you how a family could organize itself in order to start building capital for the purpose of being able to invest. What I'm going to do now is show you how the mechanism by which a family takes that money and starts to invest that money and how that money can grow. I'll show you that by introducing a term called the time value of money. Now, the time value of money is just a fancy way of saying I start with a certain amount of money today, and if the right things happen, it'll end up being a different amount of money in the future. Hopefully a larger amount of money in the future. Okay. Okay, so last time we left off with this $174,000. We went through an entire exercise to show how the family could organize itself in order to save this $174,000. Now let's go a little bit farther and dig a little deeper into this time value of money situation, right? So like I said, the time value of money is just talking about starting with a certain amount of money and hoping that in the future this money is a different amount of money. And we'll begin here at the starting amount, right? So where would I get this amount? This amount basically comes from the family tab. We'll take this $174,000. Now let's remember what this $174,000 represents within this context, right? 174, 1, 2, 3. Okay, basically what this is a starting amount. I'm saying that this family has operated under the consolidated terms for at least a year, and at the end of that year, at the end of year one, they have $174 saved up. Right now, at the end of year one, they transfer this 174,000 over, and that's basically the end of year one. Becomes the beginning of year two. Right? Okay. Next we consider this number, the monthly savings number, and this number comes as well from the family tab, right? Basically, if they have $174,000 at the beginning of the year, then they won't just stop saving. I mean, they'll continue to live under these terms. They'll continue to be able to save, and every month they'll be able to add an additional $14,500 to the amount of money that they have to invest. So I'll put that number here. Okay. Now the savings term just refers to the amount of years that they're going to be saving and investing, right? It could be 10 years, it could be 20 years, it could be 30 years. We'll start off with 10 years to just make our point, and then we'll play with these numbers and see how things will change depending on the different numbers. So let's start off with 10 years here for the term. Now, when we start to talk about the return percentage, let me explain a little bit before I choose a number right here. So basically what a return percentage is, and most of us have experience with this, even if we haven't thought about it within the context of a percentage return. But the most common example of a return that you get for investing that a lot of people will be familiar with is the savings account, right? We probably haven't thought about it like that because no one has probably talked to us about it in that context, but that's essentially what it is. When you put money in a savings account, you're basically investing in cash, right? And when you invest in cash, cash gives you a certain return percentage, and that's when you go to the bank, put your money in a savings account, and they say you're going to get about 1%. That's not a lot of money, right? But that's what this 1% represents. This 1% represents a type of return that you can get on a savings account, okay? Now, with that said, 1% isn't a real high return. So you can imagine some people, when they save and invest, they want to earn a percentage that's higher than 1%. So they invest in other things other than just a savings account, right? They may go invest in large stocks, small stocks, government bonds, T-bills, maybe real estate. All of these things have a different return profile, and they also have a different risk profile, meaning, you know, the more risk you take, the more return you can possibly earn. That's why a savings account doesn't earn you much return, because you're not taking much risk. You put your money in the bank, it's more than likely going to be there, so they don't give you much money for doing that. But if you take bigger risks and invest in other things that are more riskier, then you have an opportunity to gain a larger return. Now, what these returns represent here is the average return by asset class from 1926 to 2010. Now, I just brought this information in to kind of explain how this return concept works. So between the years of 1926 and 2010, large stocks, meaning the stocks of large companies like Walmart, Microsoft, that type of thing, they earned 10% per year as an average return. Small stocks earned about 12%. Government bonds is just a type of debt, like investing in debt, earned about 5%, and government T-bills earned about 3%. So what you see is with the different types of asset classes, the different type of things that you can invest in, you can expect to make a different return. Now, I said all of that just to say this: we have to pick a number to go in here to pretty much be a best guess of what we're going to make on what we invest in. And we can have an idea of what the possibility is just by looking at the past, right? Looking at the past, this is what these asset classes earned over the period of 1926 to 2010. Now, what some of the so-called experts, well, I'm not going to say so-called, some of these guys are pretty good at what they do. What the experts say is a reasonable return on things on the stock market, the overall stock market going forward is about 8%. So we'll put 8% here. Okay. Now, what you immediately begin to see is how this thing works, right? If a family can start off in year one by saving $174,000, and then every month after that they're adding $14,500 to that, and they do this for 10 years, and in that 10 years they earn 8% per year on their money, then at the end of that 10-year period, this family will have $3 million. Now, that isn't a typo, and that isn't some magical number that I just pulled out of the air. No, we went through this entire example, and I showed you exactly how this number came about. So, if a family sits down and does what it needs to do, saves up its initial capital, continues to save capital, and invests for years to come, then you'll begin to see the potential that they have in order to build wealth. This is how it's done. This is how it's always been done. There's nothing magical about it. And the great thing about this spreadsheet that I created, you can play with these variables and see under different circumstances what will happen. Let's say, for instance, the family did this for 20 years as opposed to 10. And you see the number, how the number goes up from 3 million to 9 million. Big increase because of the time value of money and the power of compounding interest, which I may, talk about that in detail on another video. But yeah, as you see, if you play with these numbers, 20 years, let's say a family did it for 30 years. Look how that number grows. And in 30 years, this family would have $23 million. Like I say, these numbers look huge. These numbers may surprise some people who don't understand this, who haven't been exposed to this type of thing. But trust me, this is par for the course. This is how this stuff works, right? Another thing to be aware of, not only can the term vary, but the return can vary. We chose 8% because, like I said, experts estimate that 8% is going to be a reasonable return that can be expected by people who invest in the stock market over the long term going forward. But in many years, you'll see examples where this number won't be 8%. Sometimes this number will be 10%. And you see how that goes up. Sometimes this number could be 15%. The average could be 15% over that time period. So, and you see this number just grows and grows over 30 years. If this family can average 15% per year, which is not unheard of, then you will see that this family operating under the circumstances which we laid out, this family can have $115 million. I mean, like I said, we can play with these numbers. We can play with these numbers as much as we like, and you can see the results. But the point is, if you follow this very practical pattern, this very practical guideline. So as you can see, building wealth is a very real possibility for the people who organize themselves appropriately and do things in the right way. It's not some magical thing. It can definitely be done. People just have to sit down and organize themselves and do things and be willing to do what it takes in order to hit these numbers. Now, in summary, I just want to summarize the last two videos that I made. The first one that showed how the family would work together in order to build the capital that they can use to start investing, and the one that we just talked about, the time value of money. Basically, this thing can really happen for people who sit down and understand what's going on and sit down and who are willing to work together as a unit, not as an individual. Individuals won't accomplish it. And I've shown it takes a group of people, right? So, and I know a lot of people out there may feel as if, maybe my family is not the type of family who would do that. Maybe my friends aren't the type of friends who would do that. I would say you have to give it a shot. You have to give it a shot. Talk to the people who may be interested. Talk to your friends who may be interested. Talk to your family who may be interested, and start talking about organizing. On the next video, I'm going to talk a little bit about what it means to organize and some of the steps that you can begin to take, those initial steps that you can take in order to get people organized, not just for the purpose of saving and investing, but organizing in general for all of the benefits that come along with organized people, but money just being one of them. We'll talk. So yeah, don't forget to subscribe to the channel, share the video, and be on the lookout for the next one coming.